Hey, hello. This is Martin from Secret, the channel for learning about trading and investing. Welcome to quick market analysis for tomorrow, May 17th, Wednesday, 2023. So, like we do every day, we would be analyzing the charts, technical charts, and then try to understand what exactly happened in the market, and then try to learn something from it and plan for a better trade for the next day. Here we go. This is the chart, say, of the Nifty 50 that you're seeing here. Look at this candle. It's wide range bearish. It almost engulfed the body of the previous candle, so it's heavily bearish. If you remember, we had drawn this yesterday or day before yesterday itself, this wedge, and we said there is a narrowing wedge that's happening and there is a pullback scenario that could come in, and that's exactly what happened. We also discussed that this is a rounding pattern, neckline zone. There could be resistance before it breaks out from there. That's exactly what happened. Look at Banknifty. Here the bearishness is not that severe, but it's consolidation. It's inside bar that has happened completely inside the previous candle's back, but red bearish definitely, but less bearish than the Banknifty. Momentum has dipped, but still in the bullish zones. Momentum has dipped in the Nifty also, but still in the bullish zones. And a crucial breakout zone. This is quite natural, and the only thing is we didn't have enough conviction when the market was steadily rising up, but if you remember the last slides of yesterday, if you look back, you can see that we anticipated some pullbacks to come in, but didn't have the strong conviction because the market was rolling high. That's when the markets lose surprises. So let's get into details and then find what things are in favor of the bulls. It's a rounding pattern. We've seen that it's a neckline of that, and it's trying to break out of that. It has already taken out it has already done the breakout from the trend line resistances earlier, right? And inverted head and shoulder patterns and all previous new highs are all taken, and now it went much ahead, and then it's taken a pullback. So the bullishness of the momentum is intact, absolutely no problems in that, and momentum divergence is seen on the Banknifty. It's still in progress. Trend indicator ADX is in the bullish zones in both indices, no problems there. Indices have the supports with 20, 50, 100, 200 exponential moving averages down there. Bollinger Band is still expanding, absolutely giving indicators of moving up, and the price is greater than the median, and so it probably just slipped slightly from the band top, from the walking on the bands might have paused for a bit, but it's still expanding on the upside. No contraction sign seen on both indices, so that's in favor of the bulls. Index remained with 13.29. It's not respected, but definitely it's in the lower VIX regime, also regime, less fear and create relatively, you can say, right? Fyers have been buyers for 13 days, 1,685. So last buying that they've done. Today's buying or selling information is not available, so there might have been some selling that might have happened, but data is not available. But Fyers have been steadily buying since 13 days, and it's very positive factor remains to be there. Even if there was some selling, if it is not big from the Fyers side, so it should be okay. So institutional support remains great thing for the bulls. And otherwise, across the industrial sector information, the FMCG, reality, all of them, are the bullish zones. So the major industrial sectors that contribute to the index is what we're talking about. The IT, metal, and the pharma maintains the sideways momentum. The reality sector performed 4%. Today it was down. Right? Today the realty sector was flat close, but yesterday it had done this 4% more yesterday. So we'll include that. So that's the sectoral analysis. And if you analyze the industry heavyweight stocks, basically that contribute maximum to the Nifty, you can see that the HDFC Twins and the TCS remain sideways, but ICICI Bank, Kotak Bank, and Alliance, although the momentum has dipped, it still remains in the bullish zones of the RSI from the short-term point of view. So in fees, all the stock that is bearish in the short term. And the put call ratio in the open interest data of the weekly expiry is bullish still on the Banknifty. On the Nifty, it's 0.70, but it's closer to the 1 and to the bullishness, you can say, right? So put call ratio, the open interest weekly is still not that bad. Let us see what comes out tomorrow. Also, after tomorrow is the expiry. So these are the factors that that's in favor of the bulls. Most of them continues to be there, except the price pattern that is there for today. So what's in favor of the bears? That's what happened today. So indices hit the resistance and then fell. In fact, Banknifty could not even attempt to go and touch the all-time high which it had done yesterday. So it fell even before that. 44, 144 or something it retraced. It hit the resistance and then reverse, and wide range bearish candle is what is formed in the Nifty, and also a bearish candle, not wide but bearish inside bar is what is formed in Banknifty, which indicates some consolidations. So key thing is 18,300, which is conquered yesterday, and then that's gone. 44,000 also is a key support zone that's gone now on both indices. The key thing is in favor of the bears. Intraday it was trending down on the Nifty from the beginning, but in the Banknifty it was kind of range bound within a 250-300 points range. That's what moved. Nifty was consolidating, because Nifty was breaking down for some reason, right? So that's the kind of price action in favor of the bears that happens. Ascending wedge is something that we are talking about. We've seen that, so it always gives indication that the move can take a pause. It's in the short-term chart, it should be fine. So taking the pause today, now that pause extend further, we'll have to see tomorrow. Both indices have the neckline rounding patterns that we can clearly see. Then the breakout is not happening. It's at the zone of congestion. It could break out easily just like that, or it could consolidate and break out. Both of that possibilities are there. So reversal pullbacks can still come into play, is what the PS can bang on. The momentum divergences are the momentum has got divergences. You can see that the momentum is falling down and the price is moving up. So that divergence is there in both indices, which is bearish in nature, right? Now the US market, US indices are all having resistance at the top of a descending wedge, and then it's attempted to break out from that, but it has been staying there for quite a long time. So that that red could be an indication of reversal to the bottom of the descending wedge. If the US mother market is having trouble, then obviously if they're steep, and although we are outperforming, it may not happen always. We would get impacted, of course. Lately we have been outperforming the US indices basically. Last 2 weeks with the billions of dollars coming in. That's what's happening, but it's not likely to happen forever, for long. This divergence between the mother market and the market cannot extend more beyond a limit, right? So another factor that we have been telling for the last several days is the fact that the VIX is spiking, which is spiking today is fine. It's just 1% up today, which is fine, because the market has fallen down. But in other days it has been spiking up since many days, and there was a divergence between market moving up and this big spiking. So that's exactly what we had voiced out in this video also, that it could be an indication that the move may not be for real, and it could die out. It could take a pause and all that. That's probably what has happened now. But today it has spiked up. It's fine, because the market also has fallen down. So rupee remains to be weakened near to 82.2 itself. There's some depreciation from the dollar that's happened. Rupee is still weak, remains weak. Upper interest of the Nifty is in trouble. The slip from the 1 below 1.7, although it is closer to the bullishness, it's absolutely not bullishness, because of the short build up that happens with which is so high. These are factors in the open interest which is in favor of the bears basically. So just to summarize all of these things, we can see that the market has pulled back, and clearly indicates that with the bearish candle of Nifty, and an inside bar of indicating a consolidation of the Banknifty. But Nifty is most background as compared to the Banknifty today. Remember, we had over 10 to 14% of rally, and then in the midst of this has happened. And unless there is some confirmation that comes in from the candle patterns, if the price moves below today's candle's low and things like that, until then we'll have to assume that it's an interim pause or a consolidation, before the continuation of the rally towards the all-time high and beyond that. So that's what we'll have to assume as of now. The momentum indicators, RSI, the trend indicator, ADX and all, they're all in the bullish zones, and they're intact, and the open interest to put call ratio, the strong FI buying, the expansion of the Bollinger Bands from the upside, the bullish price patterns, they all indicate that it's a probable continuation of the bull rally as long as the 18,000 and the 43,000 levels are kept intact, right? Therefore, the market view remains to be mild bullish from the side. VIX is spiking up, that's a concern. VIX has been spiking up even when the market is rising. Today it's just spiked 1%, but despite the fact the market fall 0.61%. So overall, the VIX has been spiking. Means that there is more buildup of the fear and greed that's happening, right? That's something I'm very cautious of. The US market is very cautious on, as I said, and the price pattern of the narrowing is just has shown us how the market can fall when the wedge narrows down, and it could extend further as well. And the neckline resistance also it's not easy to do a breakout just like that. So it may consolidate the zone for, we don't know how long it may take, but there could be consolidation that could come in at this, since it's something that we have to be cautious about. It means you have to be aware of the levels. So all we can do is when the market is rallied of 10 to 14%, retracements will be a simple drawing of Fibonacci levels and looking at the previous support resistance loans which are already done. We can understand how far it can go. So tomorrow's levels will be 18,100 and 18,500. What's that fun? On the Nifty, 43,500 and 44,500 for the Banknifty levels. Medium term, the resistance also be 18,500 to 44,150. And after that, support and the downside, the support zones would be 17,500 to 42,000 from the medium term, right? So that's what the bullish view, mild bullish view remains there, despite the fact that market is given strong red candles, bearish patterns, but absolutely intact momentum and trend and Bollinger Band rising, and things are not black until we get to know something tomorrow and day after. Probably Friday it should be clear whether we are going to, what is the market trying to do. Is it going to break out, or is it going to spend some time there, or is this it, or are we reversing? No, we cannot just judge that on one day's bearish candle alone. Because we had seen that the previous weekly bearish dark cloud kind of patterns were negated multiple times during this rally of the 10 to 14% rally that has happened. It has happened earlier, so it's not confirmation of a one-day reversal. Also, the HDFC was the bank that got hit mostly today, so I'm not sure whether it's related to the same HDFC related issue that happened in the May second week earlier, a few days back, right? So the view remains the same, but you have to be cautious, right? You have to position size properly and play it safe, and have hedge positions always. No naked without stop loss things. Absolutely stay away from that, and always play around with hedge positions, and but we know what exactly the risk, and you would still be in the game of, if you're taking the overnight risk, right? You'd still be the game to play it, even if your view goes wrong. Absolutely no problem if your position size is proper. So risk is the only thing that is in our highness, I always say, right? So if you watched it and then has some clarity on how to trade plan for tomorrow, then hit the like button. If you're not subscribed, please subscribe and share it to your friends. If you're subscribed, put in the comments feedback, and then share it to all. We appreciate the help and regards. And then if you want subscriptions on Telegram, then click on the link below and you can have that. So that's it. My view is clear, and hope it helps in some way. Happy trading, happy learning, happy investing. Bye bye.